read in the news that so-and-so won the lottery 3 years ago and it was the worst thing that could have happened to them because now they're worse off than they were before. If there's somebody in your family that's due to be an heir of your estate and there is no plan in place to throttle their distributions or to do whatever needs to be done to protect that person from themselves, that person will receive a stack of cash per statute, and that may be the worst thing that could happen to them.
Branden Ducharme is an investment advisor representative of and offers investment advisory services through SCF Investment Advisors Incorporated, an SEC-registered investment advisor, 10150 Meanly Drive, first floor, San Diego, California, 92131, 800-955-2517, www.scfsecurities.com. SCF Investment Advisors Incorporated and Ducharme Wealth Management are separate entities. The information in this podcast is current at the time of recording. It is based upon sources and data believed to be accurate and reliable. The information, opinions, and forward-looking statements expressed herein are subject to change without notice. Moreover, all comments and opinions voiced herein are for informational and entertainment purposes only and are not intended to provide specific advice or recommendations and should not be interpreted as such. Further, the opinions expressed are Branden Ducharme's and his guests and do not reflect the views and opinions of SCF Investment Advisors or any of its affiliates. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what is appropriate for you, consult your financial professional. This information is not intended to be a substitute for specific individualized tax or legal advice. Ducharme Wealth Management and SCF Investment Advisors do not provide legal or tax advice. These services are provided by separate entities. The guest speakers featured in this podcast are not affiliated with SCF Investment Advisors, nor are they affiliated with Ducharme Wealth Management unless otherwise indicated.
So what I have here is ChatGPT.
Okay.
Most common questions that people have about estate planning. And here's the deal. I asked ChatGPT for 5 specifically. And apparently these questions are so important to people, as determined by ChatGPT, that it actually has given me 9.
Wow.
So you ready?
Let's do it.
Okay. Number 1, gift and estate taxes. People are curious about how gift and estate taxes will affect their ability to transfer wealth to their heirs. Preston, what do you know about gift and estate taxes?
The first and most important thing I think for most people to know is that gift and estate taxes are not going to be an issue for most people. Unless you have a very large estate. We're talking in, presently, if you're an individual, over 13 million. And if you're a couple, double that, $26 million. Gift and estate tax is probably not going to impact your estate plan. The thresholds for the estate tax exemption are set to sunset in, I believe it's January 1st, 2026. So unless Congress acts, the thresholds will be basically cut in half. That will mean that for some people, and again, it's not, the thresholds will be probably in the neighborhood of 7 million per person or 14 million for a couple. And if your estate is not bigger than that, again, it's probably not going to be an issue for you. If your estate is bigger than that, the way it works is you have a certain level, a certain amount of gifts that you can give each person in your life. Whoever you're wanting to give gifts to, you can give them a gift of that amount, and it doesn't count toward your exemption amount. Okay. So, for example, maybe it's $17,000. I could give you $17,000, and it wouldn't count against my exemption amount. If I were to exceed that and go up to $18,000, then I would need to file a gift tax return, and then that $1,000 extra would be remembered until I die by the IRS and would count against my exemption amount in the future.
Unless you don't want to claim an exemption, you have the right to just pay
Sure.
the tax if you feel for some reason it's a good tax environment today or whatever reason. You do have the ability to pay it, correct? Like now, instead of using some of your exemption. I don't know why somebody really would. That would be really maybe a unique strategy, but
Yeah, because there's no tax due unless at the end of your life
you've far exceeded the limit or
right.
you know,
It wouldn't.
whatever. I mean, I think it's a silly strategy. I'm just saying from a technicality standpoint, I think you can. You wouldn't, but you would have to file. You would have to file a return every single year, carrying essentially that gift forward, right? That's how the IRS is going to remember that. It's going to show up on a tax return, I think, every year.
Perhaps, and I would once we get into that far, I'll defer to the accountant on how that all works.
I'm not the accountant either. I think it's similar though to like when you file an 8606 for cost basis in like an IRA. You have to refile the 8606 every year to update the cost basis, or just say it hasn't changed. Okay, real estate and business inheritance. Questions frequently arise about the impact of estate taxes on heirs inheriting real estate or family businesses. I think that's one component of it. It says that other people also who has the responsibility of the taxes, and how can you plan for adequate liquidity in the estate to cover taxes and expenses essential to prevent forced asset sales.
Again, so in some sense, this is a question that doesn't apply to most people. To the extent taxes are relevant to, or estate taxes, real property taxes are relevant. Is that the question you're asking me?
I just said talking about the transfer of real estate and business inheritance. Most people's concerns aren't necessarily, according to ChatGPT, most people's concerns are not around like passing title per se.
Right.
But what are the other implications around passing that real estate? Like, are there tax issues with passing real estate? Is there, are we going to need liquidity for expenses in the meantime? Or how does that all happen?
So when we're transferring real estate, you have what's called a step up in basis. So if I inherit real estate, I get to have a step up in basis, assuming that I'm actually inheriting the real estate. Where a lot of people run into trouble is that they will put they intend for their adult child to inherit the real estate, and so they put that person on the title
while they're alive.
This can be a very huge mistake because that person the child now presently owns the real estate.
Yeah.
And they don't benefit from the step up. The step up in basis means that, just for anybody who maybe doesn't know, so when you purchase a piece of real property, in essence, the price you bought it for is the basis, and maybe you add some improvements or so on over the course of your ownership, and those things together constitute your basis. When you die, there's a capital gains tax on the difference between the basis and the sale value when you go to sell the house. However, if your adult child or if your child inherits the property, then that basis gets to step up to the present value, and so it in essence eliminates the capital gains tax.
Yeah.
If that property's been inherited. And so that's largely what most people need to know for estate, for real estate taxes as it relates to inheritance and estate planning. It's important to have the real property be truly inherited rather than joint ownership while the parent's alive still. Yeah,
there's somewhat of a nuanced difference maybe between transferring ownership and inheriting, right? All inheritance maybe constitutes to some level a transfer, but not all transfers are inheritances.
Sure.
Like the old, every square is a rectangle, but not every rectangle is a square type deal.
Yeah. In the parent's head, they think it's an inheritance, but really it's an immediate transfer.
Yeah.
And then there's a whole host of other problems that I don't know if ChatGPT is going to ask me those questions or not, but there's a whole host of other problems with putting a child on title.
Yeah.
And even an adult child on title, whether it's real estate or a bank account or anything else. That's a big issue that people, if they're not asking the question, they should be.
Yeah. So just looking at the list real quick, I know kind of where you're going with that. I think it's super important, and ChatGPT does not have this as one of the things. So where I believe you're taking this is if you put a child on title, their creditors are now your creditors.
Yeah.
Right.
Their creditors are your creditors. There's no way to get them off the title unless you buy them out.
Yeah. Because they legally own it. You got to take it back. It's not revocable.
Right. Yeah, exactly. There's no way to amend that gift. It's a present gift, and there's no way to amend it. And sadly, I've seen where there's a falling out, and now all of a sudden, a child has a whole lot of leverage to extract money from mom and dad as a result of a transfer like that.
Super sad.
Super sad.
I think we probably could do a whole episode on the pitfalls of owning assets or real assets with other people.
Mm-hmm. Yeah.
And the pitfalls of potential creditor issues. You know, it's really important when you're going to do that kind of stuff to know who you're sort of owning stuff with.
Mm-hmm.
Right. And that's probably a whole topic of discussion, but super, super important nonetheless. To put numbers to what we were talking about. If you bought a home, a long time ago for $100,000, and let's say you remodeled the kitchen at one point for $25,000. Mm-hmm. When we say your basis, we mean your cost basis, right? Which means in total for the home, realistically, you've paid $125,000. And so say the home is now worth $300,000, mm-hmm. and you just go put Johnny on title with you, and you're still alive, but you give him half the interest in the home because you've added him on title. He's likely not going to have a tax implication, because even though you've given him that gift of essentially $150,000, it's going to fall under your gift tax exemption, likely.
Okay.
Right? That's part of a conversation maybe. And so people don't really think too much about that, especially if they're in this scenario. Usually people that are going to have gift tax exemption limits reaching their lifetime just already have an estate plan. But nonetheless, when you pass, if you had waited, he would have gotten the home with a cost basis of $300,000, right? Because year 125 would have become 300. And
right.
So if he would have immediately sold the home for, say, 300,000, he would have paid essentially no taxes on it.
So he could sell the house immediately, and make and
not pay taxes.
Right.
However, because you added him on title, he doesn't get that full step up in basis. He only gets half of it. So he's only going to get the step up from 125 to 150,000, half the home. Like their half is going to step up because their cost basis is still 125,000.
Are we talking about a couple, or who's the owner of the home?
Mom and dad.
Mom and dad.
Mom and dad with Johnny.
So. In a state like Utah, that's not a common community property state.
Okay,
you get the base. Let's say dad's dies first. Dad's basis gets stepped up for mom's purposes.
Okay,
he owns, let's say, half the house.
So he's going to end up in total. Dad would end up owning the other half, right? So he's kind of winds up. Johnny owns half. Dad owns half.
Well.
Now,
why don't we do this, just for purposes of the listeners and simplicity? Let's pretend we're in a community property state.
Okay,
it's a lot simpler.
Okay.
When they get a double step up in a community property state. So dad dies, mom gets a complete step up in basis. So as of dad's date of death, the value is now, and let's say it's $300,000 on the date of dad's death. That's the value of the house.
Yeah.
And let's say it's an investment property, not the primary residence, also for simplicity's sake.
Okay.
So this is an investment property. Mom now gets the new basis, the date of death basis is now $300,000 because that's the value on the date of death. When mom dies, and let's say the value is now $350,000, the children get a new basis of $350,000.
But if they had put Johnny on title, their basis would only become
The basis would be the 125.
the 125 plus, it'd still have some gain in equity, right? They still own half the interest of the home. So there's their basis. So Johnny's new basis would have stepped up to 150 because he had no cost basis in his interest. He was gifted it.
Right. Mm-hmm.
And so, the other half of the home would step up to the fair market value of 50% of 300,000. So now Johnny says, well, now that mom and dad are home, or, now that mom and dad passed, I can let go of their investment property that they love so much. And I don't really care for it though. So I'm going to go ahead and sell it. So I'll sell it for the 300,000, but instead of paying no taxes, he's going to pay taxes on $150,000 of it.
He'll
income on that.
He will have
likely long-term capital gains depending on holding period.
Right. He'll have a tax burden. Since this isn't his primary residence, he doesn't get that exemption.
Yeah.
And so it's
okay. Nuance. So the key takeaway there is that it's, not always, because we don't deal in absolutes, but very likely to be a very poor idea to add other people on title to your home in any capacity.
For tax purposes, among a litany of others. Yes.
Yes. What about and business interest? How does that transfer?
How does it transfer in what scenario? So if
I don't know, like how do you leave Johnny the business?
So the way that I like to do it, and there's differing opinions on it, but the way I think is typically a good strategy for many people is to let's say it's an LLC. Let's say I own the LLC, and Preston Mathews owns this LLC, but I want to leave it to my kids. What I'll typically do is I'll have my trust. And I want to keep my LLC in my own the ownership in my own personal name, just for simplicity's sake. And then there'll be an automatic assignment of my interest in the LLC to go to my trust upon my death.
Where does that automatic assignment of interest take place?
That takes place.
Write it in a will, put it in your trust.
It's a separate document.
Tell all
typically.
your friends, make a Facebook post. I don't know.
Yeah. No, it's when you do your estate plan, you're gonna prepare a will and a trust and a couple of other documents, powers of attorney, and so on. One of those documents, if you own interest in a company, will be an assignment of the interest that will take place. So it's a separate document. It's just a mechanism to put that asset into your trust automatically upon your death.
Yeah, cool. Life insurance and estate planning. People often ask how life insurance policies should be incorporated into estate planning, especially with changes anticipated in tax exemptions. Utilizing trust to own life insurance policies can be a strategy to exclude the death benefit from the taxable estate. I'm going to kick this off by saying it only matters if you're above that gift tax limit. So for most people, so for the mass affluent out there, and even high net worth families, this strategy in the current tax environment would not be super beneficial for you. Now, ultra high net worth, it starts to have conversation. For the ultra high net worth? What's the strategy on where you want to own life insurance so that it can be used as a tool and not a burden on the estate, if you will?
I'm going to defer on that one. I just feel like
too complex.
It's complex, and it depends on the unique circumstances of the individual, what else their estate looks like, what else do they have. I don't know that I would want to put a general answer out there.
That's a great answer, though. Have you dealt at all with ILITs, irrevocable life insurance trusts?
No, I haven't got into that.
They have become significantly less popular with the increase of the gift tax exemption, right? However, there's a kind of a crowd or a demographic of people in the industry that believe that the taxes are going to go up so significantly and everything's going to be taxed out of existence, and you're just going to be taxed out of existence. So do everything you can to get to tax-free money. And to a certain degree, I have some agreements there. I like tax-free money as much as as much as anyone, right?
Right.
However, it's like currently not exactly the most effective way. And it's kind of, it does cost a lot of money and logistics and and stuff to not only initiate, but keep funded and keep open and stuff. So a strategy that if the gift tax comes down significantly or doesn't adjust quick enough for a dramatic increase in inflation, maybe it's worth revisiting. How many times should people update their estate plan? This is a big question people have.
Yeah, and this is I like this question because this is one that's generally applicable, not just to high net worth people. You generally should have your estate plan amended, revised, so on, or at least looked at when you've got a major change happening in your life. So, a death of a beneficiary, a marriage, a divorce, a new child is born. Those types of events are definitely time to come and have your estate plan revisited. Make sure that it says what you think it says. Make sure it accounts for this new scenario that's come up. So, for example, obviously if you have a new child, you want that child to be included in your estate plan.
Yeah.
Suppose you have a death of a child, maybe that affects how you want the distribution to be. Suppose I'm the person who created the trust and my spouse passes away. And maybe I remarry, something along those lines. That's definitely a scenario where you want to come in and get your estate plan revisited because now there's the potential of stepchildren, half siblings, and a second spouse bringing additional assets into the estate. All things that add complexity to the estate plan that weren't considered when you did it the first time.
Yeah. I think the big question I get a lot of times is, hey, I've moved to a new state. Mm-hmm. Do I need to get a new estate plan?
Yeah. And that's a good question. And I would say not in every case. A lot of people are asking that question kind of because they're wondering, is my estate plan still valid when I've moved to a new state? And the answer is typically yes to that question. Mm-hmm. However, there are certainly advantages to having an estate plan prepared once you move to a new state. It's one of those major life events that should cause people to come and have their estate plan revisited. Mm-hmm. And it's definitely beneficial to have to at least have it reviewed, have it in your brain, and sit down and think about, is this how I want it? And the way it's written presently, does that jive with the state laws where I'm at? So, for example, if you're moving from a community property state like Nevada or California to a non-community property state like Utah, then it would be definitely a good idea to have your estate plan reviewed.
That's very fair. Okay. Especially if you're moving between states that have different types of laws around estates.
Mm-hmm. Yeah.
Okay. People have a lot of questions, according to ChatGPT here, about decisions of incapacity. A key question involves who will make decisions on your behalf if you become incapacitated. Designating someone through a durable power of attorney, a healthcare proxy, and a living will can ensure that your financial and healthcare decisions are made according to your wishes without court intervention. That was more of the answer than it was, I think, ChatGPT.
Right.
Give me a concern.
Yeah. And I think that pretty well covered it. So it's important. Maybe the question is, maybe the real concern people have is, if I don't do anything, then what happens?
I always tell people this is like, everyone has an estate plan. Mm-hmm. Okay. It's your plan, or it's the state's plan.
Right. Yeah. I like that.
That's it. Everyone's got it.
Uh-huh.
So it's really easy to know what happens if you don't have something. Just look it up in the Utah code or whatever state you're in.
Mm-hmm.
And I believe it spells it out.
It does.
And it's usually not what you want.
Right. And most people are not eager to dive into the Utah state code, but in essence, what it is that if it's very simple to set up a power of attorney for your finances and a power of attorney for your healthcare, and to do a living will to set out how you want your agent to act, how you want the doctors to, what decisions you want them to be making. You can set those out to kind of take the burden off of them. If you want to take the burden off of them on these kind of end of life decisions where, if I'm in a vegetative state, what do I want to have happen in that scenario? Do I want to be kept alive? Do I not? You can kind of take the weight of that decision off your family by making that decision ahead of time. And then, in addition to that, and probably even more importantly, it's very simple to designate somebody as your power of attorney who has the authority and power to make those decisions for you. If you don't, it becomes a process where you've got to go to court, or your family has to go to court and ask the judge to appoint somebody. Mm-hmm. And then that person will make the decisions. And the fact is that court process is probably more expensive than most people think, and it's more time consuming than most people think. It's far preferable to just sign the piece of paper far in advance.
Yeah. I always think, when you think about public speaking, right? And they say, if you think you're talking fast, but it's really going slow, or vice versa. Like there's these big shifts in like what feels like a long time, or an attorney, right? If you're talking to someone and there's this pause in the conversation and it can feel like it's, like forever, and it was like 2 seconds. Right. Right. But it feels like so long because there's just so much going on. It's a high stress conversation. And right. Mm-hmm. I can only imagine that if you were in a situation where you had a loved one that was, incapacitated in a hospital or whatever, and now you're trying to help them, it's not just like, well, fill out this form online really quick and shoots it over to a judge and they just sign off and you'll be good to go. Like, everything in the world today is so fast normally. Right. But no, it's like you got to call up and, hey, Preston, can you meet with me this week? And, mom or dad is in the hospital, or my spouse or whatever, right? And can't make decisions for themselves. And we need stuff drafted and put together. And then we got to take it to court. And then we got to get them to sign off on it. And then I got to go back. And that time period, I can only imagine is like the same thing, but just like times 100. You know, it's got to feel so long when you are in that moment when you need a durable power of attorney in place, or a power of attorney for anything, right? But you don't have one yet. Right. Oh man, it's got to like, I can only imagine the pain that people feel in that situation. Yeah. I always try to help people understand that I think it's a really commonly discounted part of the estate plan, if you will, not in terms of pricing, but everyone like forgets about it. Like it's some ancillary thing that's just not that important. Or right. I need my trust and will, it's like, well, there's this worst scenario that you stay alive sometimes. And believe me,
it's arguably the most important document in there. Yeah. I mean, because you're still alive. Yeah. This has to do with your care, and you can't speak for yourself. And so you need somebody else to speak for you. And then the process that you described takes weeks at a minimum to find an attorney, talk to the attorney, have the documents drafted, file them with the court, get a hearing date, show up at the hearing date, and finally get your order. Yeah. And then if it's an emergency, all that process I described was expensive. If it's an emergency, that makes the price go even higher because the attorney then has to drop everything they're doing and deal with this emergency issue. And you're asking the court to do the same thing, which requires extra paperwork to get this, it can be quite a nightmare for families.
Okay. Power of attorneys.
Okay.
All right. Distribution of assets. So the concern is who gets what, when and where and why and how.
Great question. Under the estate's plan, if there is no estate plan in place, it's typically the estate's typically divided equally among the heirs. And with the caveat to that is obviously that each state has its own rules and laws, and marriages and second marriages play into that.
So would like a simple, maybe nuanced example of that be if, say, so mom and dad have, 4 kids, and one of the kids tragically passed away. But they had a couple of kids before they passed away. And now mom and dad have no estate plan. Their assets in some states might go, and I believe the term is per stirpes, right? It would just go like, a third to each one of the kids that are still alive. But then in some states, it would still go a fourth to each one of those. And then that other fourth would then get split equally amongst the kids of that kind of fourths, right? Like that kid's heirs, right?
There's different schemes. There's, does each branch of the tree share equally, or does each survivor share? How is that all done in each state?
And that's where each state gets nuance, right? So we start talking, the state's got a plan. The state knows how this is going to go. It just very well may not be what you had in mind.
And whether you have a spouse, like there's a second, first spouse, either divorce or death, and so second spouse, and then, there's potentially kids from a prior marriage, and how does that all play in? Like all these things affect how it will be distributed according to the state's plan, and so it's far better to have a plan in the first place that you get to set out and decide who gets what and how, not only who gets what, but how and when it'll be distributed. That's a huge part, because there's a lot of times when you have people who receive a big stack of cash, and just like you see in the lottery, you read in the news that so-and-so won the lottery 3 years ago, and it was the worst thing that could have happened to them, because now they're worse off than they were before. If there's somebody in your family that's due to be an heir of your estate, and there is no plan in place to throttle their distributions or to do whatever needs to be done to protect that person from themselves, that person will receive a stack of cash per statute, and that may be the worst thing that could happen to them.
So much more common than people would expect. In fact, I think I'm going to do a whole podcast on it.
That's a good idea. Yeah, there's these like you'll hear stories and you say, "Man, I can't make this stuff up."
I have both seen and heard them, and I've seen them when they turn out okay. But I would say that that's less common to be the case, especially the younger somebody gets. If you think about, somebody getting, let's call it $1 million, and they're 19 years old. That's going to be life-changing, and statistically not in a good way.
Right.
Which in every essence, like that should be, the whole point of that money typically is to try to make the life-changing difference for somebody.
Right.
And now you're potentially doing more harm than good.
Right.
So distribution of assets, is that pretty customizable? You can choose how you want that done when you do your own estate planning. You can decide that different people get different amounts at different times. You can qualify it. You can, right? Is it customizable like that, Preston?
Yeah, it's very customizable, and each person has a different idea of how they want it done, and that's one of the parts of an estate plan that's the most customized. Is okay. How are we going to do this? Another factor that has to be considered, or that a lot of times people will consider, is, have I given gifts to one or more children and not others during my lifetime, and do I need or want to account for those things? In the estate plan. And so all these things combine to create a customized estate plan where we can adjust the distributions. We can, what I call, throttle them, where we give a graduated distribution over time. We can set up a scenario where there's creditor protection, where we create a sub trust that has some creditor protection benefits for the beneficiaries. There's a laundry list of ways that this can be customized.
You can do, in Utah, can you do trust that protects somebody? Like if you have, this is an extreme example or whatever, but this is how and I'll say, like, this is how my own family's trusts are set up. When you start talking about through generations, where the money flows into a subtrust, and essentially it's similar, and it might be the same as a creditor trust actually, but it's keeping the spouse that's not blood kind of away from the family money in a sense. So that way, if something happens, it stays more aligned with the bloodline, right? Until those funds become commingled.
Yep.
Right. So you could transfer them into your own marital trust,
right.
But you can't keep them separate.
Right.
So if you have, maybe all your kids are young and first couple of years, you don't maybe trust the new spouse or something extreme or whatever. And that's everyone's right to do whatever. I'm not saying that you should or shouldn't or whatever,
sure.
But there's it as an example of how customizable this stuff can be. And the reason it is you customize any of this is to meet a particular need or goal that you have with your own personal planning, right?
Right.
Everyone's situation is totally different and you feel differently about different people and different things and at different times and in different places you feel differently, right? So,
right.
Things change and that's why you can update it.
And let me before we move on to the next one, I feel like this is a good time to say this, that what I just said can be kind of intimidating to people, that there's, a spectrum of options and that's in some ways maybe even limitless options.
Yeah.
And that sounds complex and it sounds difficult and it makes some people say, I don't want to think about that stuff. I'm going to put off getting a estate plan for another day or another week or another month or year.
Yeah.
Your attorney can help you with the complex part. Your attorney's job is your job is to just say, this is kind of what I would like to see.
Yeah.
And it's the attorney's job to figure out the complex part of how to achieve that. So when you sit down with the attorney, it shouldn't be and it's generally not unless you have a really huge estate.
Yeah.
For most people, it's a relatively simple process, and let the attorney handle the complex part. Don't be scared off by, boy, that sounds like a lot of work. The attorney's the one doing a lot of work.
Yeah.
You just have to come and tell the attorney what you want.
Well, it's kind of a lot more like investing, just tell us kind of where you're at. Tell us where you're hoping to go. Let me worry about picking investments and rebalancing and doing all the complexities that, it takes time and energy and understanding and all that.
Mm-hmm.
And, we'll try to get you there.
Right.
So I remember the first time my wife and I went and do estate planning, I really was trying to overcomplicate it. And my wife was getting pretty bugged because, well, I am one to think personally, this is my own personal view, that if you give somebody a stack of cash, like it's going to be not good. Right.
Mm-hmm.
And so the attorney, his kind of like default was, well, give them a chunk at 18, give them a chunk at, I think 21, 25 and 30 or something. Mm-hmm. And I'm like, no way, and then you start dealing with, you're trying to solve, these really nuanced problems about, okay, well, who gets, how does the income from the trust get distributed for, tax purposes, because you don't want the trust to have the income tax because it's a way higher rate. Mm-hmm. Right. Like there's all these things. And my wife was like just getting overwhelmed and probably quite frankly, and rightfully so, a little frustrated with me. Like, I think she was either pregnant. I think she was pregnant when we went in the first time, or we were like trying to have kids.
Yeah.
I can't remember, but it was like, come on, dude, are you serious right now?
Mm-hmm.
And, so we went back I think a year later, and I was just like, you know what, I can revisit this as like my kids get older, and I can, when we put more thought in and we have more need for complexities and kind of know what the family situation shakes out to after we're done having kids and all that. And so I was like, look, I just don't want them to have a lump sum, and that's, he's like, all right, yeah. And we came back and it was like, all done. It's like, here's all your documents. It was so easy once you're just like, okay, like, look, this is my concern. Can you just help me solve that? And he came back with something that was pretty reasonable. And we went, okay,
Right.
Okay. Leaving instructions. People inquire about the best way to leave instructions regarding distribution of personal items or financial assets. So I think this is like, what do I just like tell everyone? I have an estate plan somewhere. Do I tell my kids I did an estate plan with, Preston at his law firm? Do I tell my kids to call my financial advisor? Do I give them a copy? Do I have to give beneficiaries a copy of the estate plan? Like what the heck? So I went and I think so again, it's like I went and met with the estate planning attorney, and now I have this 3-ring binder that's 500 pages thick or something.
Yeah.
And hopefully the kids find it or something, but I also don't really want to tell them that I got this done, because then they'll want to know what's in it and not. So now I'm just at a loss. What do I do now?
Yeah. And this is so, well, before I get to your question, let me just address what I picked up on as kind of a false assumption in that question.
Yeah.
And that is that you can just simply leave instructions for how you want your estate divided, and that will be functional as an estate plan. And I don't know, you're looking at the text. Maybe that's not what it says.
I'm talking about like like you have the estate plan done, right?
Yeah. Well, in case anyone I don't know.
It's good clarification.
Yeah, I feel like it's worth clarifying.
You can't just say Johnny gets the cars and Susie gets the jewelry,
because that's a common scenario where people think, well, my kids will do the right thing. If I just write down what I want to have happen, then the kids will just do the right thing. And that's how I understood the question as, how can I just leave instructions for the kids to do the right thing and make the right decisions? Yeah. The fact is that the kids all probably have a different idea of what it is that you want done, even if you told them expressly what it is that you want done. They all have a different idea. And even if they all were in agreement as to what you wanted done, they don't technically have the authority to make those distributions. They could do a side agreement, perhaps, but the court is going to distribute according to the state statutes if there is no valid estate plan in place.
Yeah. So, for example, say you have 4 kids, and little Johnny became a neurosurgeon that's got and has wildly successful practices all over the country. And he's worth millions and millions of dollars. And mom and dad leave behind a meager $200,000. And the other 3 siblings always, maybe they have admirable careers, but they don't, have as much resources. Yeah. And so mom and dad didn't do the estate plan. State divides it up fourth. And Johnny says, hey, mom and dad helped me with medical school. And I always said, you don't have to leave me anything. And so I don't even need any of this. Mm-hmm. And the judge is still going to say, well, here's your check.
Right. Yeah. I mean, perhaps,
it's like
they can disclaim if they're so inclined.
Sure. But it's just an added layer of complexity, where now there's, anyways. Yeah. So and that happened. I feel like that happens more often than people care to admit, right? Like some kids are doing great and the parents just like, well, we helped them earlier on, right? Like you said earlier, kind of that mental accounting, like, well, maybe 2 kids we helped through college and the other 2 kids never went to college, and so we're kind of adjusting, present value and future values. And I think the other 2 kids that kind of have left now maybe should inherit more. Mm-hmm. Not saying anyone should do that. That's not my opinion or view, but if somebody was doing that, you want to make sure that you have it. You can't just tell all that. You can't, even if you sit all 4 kids down, like you're saying, and expressly say, you 2 are disinherited, you 2 get all of it, split it equally, like so plain and clear. Mm-hmm. That still is not good enough. What if they write it down on a paper? Like, okay, they type it up and I'm being very specific with my question here. They type it up in Microsoft Word, print it out, take it down to the bank and get it notarized, and say, these 2 are disinherited, these 2 split everything else. Mm-hmm. Is that good enough?
Depends on what state you live in, and maybe even what the judge had for breakfast that morning. And I'm serious. I mean, in Nevada, not a chance. Yeah. In Utah, maybe. And it's not clear cut. That's a risk. That's a risk to do it that way.
Big risk.
But
and I think people are thinking, well, it's my will. It's my thoughts. I put them on paper. I clearly signed it. And I had it notarized.
And this is where people get, they misunderstand that leaving your assets to your children is not a constitutional right. It's not something that's, endowed by our Creator and so on and so on. This is a product of statute that the state government has set out that allows people to do this. And because of that, the state can put whatever requirements they want. And so in a state like Nevada, the requirements are very strict. If you're going to write your own will, if it's not properly executed, witnessed, and so on, in accordance with the state statutes, there is another statute that says, well, you can do what's called a holographic will and write it down, but it's got to be in your own handwriting, and it's got to be signed, and it's got to be dated. And that counts. But if you don't do either of those things, let's say you type it up and you don't,
you kind of have components of both, but not either one fully.
Yeah, there's a high probability that is not going to cut muster, and most people are not looking up the state statute before they write a holographic will, or they kind of have an assumption on what they saw on TV about what constitutes a valid will, and so they write it down and sign it, and maybe even go to the bank and get it notarized, and without looking at the state statutes, and even sometimes the state statutes aren't clear, there's a chance that could be not valid. For example, if and I've had cases like this, somebody goes to get an estate plan done, and it's typed up, it's formal, it's witnessed, it checks all the boxes, it's a valid trust or will. But then the person whose will it is or trust goes in and starts lining things out and making changes.
Yeah.
The legal question is: are those changes valid? Will those changes be enforced? And that's a legal question that, depending on the size of the estate, can be literally $1 million question or more.
Cost you $1 million to get
yes,
answered.
That's what I mean by it. Yes.
Yeah.
Well, it probably won't cost $1 million to get through that litigation. Hopefully not. But
so you're Elvis Presley and die intestate with that kind of estate.
Yeah, but even on if an estate is worth enough, I mean, who gets the millions of dollars in the estate depends on whether those lined out items are enforceable, perhaps.
So there might be a lot of interest in dragging that out and paying attorneys a lot of money to argue that.
Right. There's enough ambiguity to create a case, for sure.
And now your money's funding, the attorney's next Mercedes instead of going to whatever it was that you wanted.
Yeah. Well, so let me answer the question that
the original question.
The original
okay,
question.
so you have your estate plan. Like, how do you get the instructions to let people know? Hey, I have an estate plan. I want people to know I have it, or I want them to be able to I want it to come out, right?
Yeah.
But oftentimes people don't want to just share their estate plan because, like maybe they don't want one of their kids to know they're disinherited,
right?
Or they are concerned that maybe if somebody got it, they could alter it.
Yeah. There's all kinds of reasons not to give your estate plan to anybody. And you've identified some of those. You don't want people relying on it, and in doing so, not making their own way in the world. You don't want anybody. Hopefully, nobody's trying to change it, but that'd
be an extreme case for sure.
That there's plenty of cases about that. And you don't want people fighting over it prematurely. You don't want people unduly influencing you. Mm-hmm. Suppose you're starting to lose capacity and you're more and more relying on your adult children. You don't want them to, or even the allegation that they've been unduly influencing you to make changes to your estate plan that benefit them.
Yeah.
There's a whole lot of reasons not to show anybody your particularly your will or your trust. But then, as has been identified here, there's also the scenario of, well, if nobody can find the estate plan or get to it, it doesn't do any good. And so if the estate plan is locked in a safe and nobody can access it, or if it's hidden somewhere in a book, I'm telling you, this happens.
Yeah.
Somebody left their holographic
Well,
and
the old French dictionary with a revolver.
Right. This happens. Yeah. I've seen this happen in more than one occasion. Leave it somewhere where nobody will find it. Or if they do find it, then is this really a will? It looks more like a letter. There's all kinds of things. But yeah, so you've identified a good problem though, that, okay, if nobody can find it, it doesn't do any good. Mm-hmm. So, I let people make their own choice on it. And a lot of it has to do with their own family dynamics. Some people have families where really seriously and sincerely everyone gets along and this is not going to be an issue. In that case, I say, that's up to you. Obviously up to you. And if you feel like it's, you want to share it with your children, go for it. But other scenarios, and I'm not saying that if your family gets along, then you should share it. I'm just saying people may decide to do that, and I don't think it's the end of the world. But generally speaking, my advice would be, you don't have to share this with anybody, and you probably shouldn't, particularly the will and the trust. If you want to share your powers of attorney, perhaps you could do that, and that may be beneficial. You want to let those people know that you're asking them to take on that responsibility, and
you're giving them authorization. You can't make them do it.
Right, exactly. Yeah. And you want them to know that they're the one that's to be doing this, and you want them to know perhaps where that document is located, so that if they need it, they know where to get it, and then they can take it to the doctor and say, I'm the one that has the burden of making this decision. And so a good idea is typically, you can leave instructions somewhere as to where to find your estate plan. You can give out maybe the power of attorney. That I would say the healthcare, maybe the financial power of attorney. Maybe you can give a copy of that, or let them know where to find it if needed. Or you can, even if you leave a business card of the attorney that drafted it somewhere that's easily findable, people will often draw the conclusion, maybe this is the person who did the estate plan. So there's a few options.
All right. The next question is going back to the trusts and taxation. Mm-hmm. Does getting a trust save you money on taxes, Preston?
If you are getting a revocable trust.
Yeah, let's talk about just revocable. If you go get a revocable trust, does it save you any money on taxes?
If you get a revocable trust, generally speaking, it's not saving the grantor, the person whose trust it is, generally not anything on taxes. It doesn't really change anything.
So I can't just take all my income, put it in a revocable trust, and just say, well, no, I didn't have any income. The trust has it. So
right. Yeah.
I don't have to pay the income taxes now.
Unfortunately,
that doesn't jive.
Yeah. It doesn't work like that.
Is there a secret trust that the billionaire families know of that if only we knew of, that we could use, and we would just all become, sheltered from taxation? Is there something like that exists that we could just go ahead and spin up for me real quick? And
no, yeah, I don't think so. If certainly there are measures that they can spend a lot of money taking, and it's worth it to them because they have a very large estate and they can do X, Y, and Z. Yeah. And maybe it's legitimate. Maybe some tactics are legitimate. Maybe some are not. And even worse, a lot of times it's a gray area on whether this actually is functional as a tax avoidance strategy. And so
somebody gets to be the lucky winner that gets to become case law.
Right. Yeah, exactly. You don't want to be the one who's the case law. Yeah, exactly.
So I think one of the things I always try to highlight for people is that even if there is something out there that makes a marginal difference, and maybe it makes, like, on its face, it makes a huge difference in taxation or investment return or in any of this stuff. But the complexity to get there, if you have to pay attorneys hundreds of thousands of dollars a year to make this happen.
Mm-hmm. And the administration cost.
It's not worth you saving $10,000 on taxes. Mm-hmm. So even if your tax bill was, say, even a couple $100,000, you're still not even close to you're still likely not even close to needing these potentially gray area, fancy tax solutions. I think there's like a lot more options that people can do and take advantage of from a tax planning perspective that are not so speculative, maybe.
Right. Yeah.
Right? That may be, ultra high net worth families may or may not use, or it might be worth it for them.
Right. Yeah.
So,
and anytime somebody's really trying to avoid taxes or avoid creditors by creating an estate plan, it's not off to a good start.
It's usually not.
Yeah.
I have people ask me all the time. One of the questions I get is like, I think we need a revocable trust to save on taxes, not a revocable, irrevocable trust. I need an irrevocable trust to save on taxes, what people say, and I'm not exactly sure where the cutoff is on where some of this stuff may or may not make sense, and I'm not an expert on it. But I just ask them the question, like, okay, are you okay giving that money to an entity, or like are you okay giving up complete control of that money? Because they go, well, why would I have to? So, well, that's what an irrevocable trust is. You no longer own it. You're giving it away. Yeah. You're hoping I kind of think wherever you give it to, you're hoping they, maybe give some back to you, or, especially maybe when you ask. But if you don't own it and you have no control over it, which is what irrevocable would mean, you better say pretty please, and they have the ability to make you, right? Like it can. Yeah, I mean, that kind of thing can go really bad really quick.
It depends on what state you're in, what the requirements are for. You're kind of referring to the trustee. You're basically giving it irrevocably, giving it to another trustee, and then there's different state laws on what power that trustee has versus what power the grantor has, and whether you can be a co-trustee with that person, and what the parameters are. So it's quite complex, really, as you can imagine, but it's in the name. You're absolutely right. It's irrevocable, as in once you give it away, you can't take it back, and that should be a big red flag for most people. Yeah. Again, it for some people, a very, very small amount of people, right? It'll work great. There's some great situations, but for most people, it's a little over the top. Okay. Choosing a trustee. This is maybe the most important question. Yeah, this is huge. How do you choose a trustee? Because remember, you can't force anyone to be a trustee. You can't make them. You can't make them be a trustee. Yep. So what makes a good trustee? How do you choose that person? How do you designate them as a trustee? And most importantly, maybe how do you approach a conversation to let them know that that's something you're kind of asking them to do, and that it'd be meaningful to you if they were willing to do it? Yeah. So picking a trustee, it's kind of in the name. This needs to be somebody that you trust, somebody that will make the decisions that you expect them to make, and in the way that you expect that they would make them. And it's hard because everybody has a different way of handling things. You might trust somebody as a person, but maybe need to recognize that they may not make the same decision that you would make. However, they will make a decision that's in the best interest of the beneficiaries. And that's really what it comes down to. This person needs to, what their job is as trustee is to marshal assets and administer the estate for the benefit of the beneficiaries. And by making somebody the trustee, you're giving them that power and that discretion to do what's in the best interest of the beneficiaries. And so it really does need to be somebody that you trust to manage those assets, and to not be siphoning things off, to not be picking on a certain beneficiary or being unfair to a certain beneficiary. Ideally, it's somebody who doesn't have an interest in favoring one person over another. It's somebody who doesn't need money, and so they're not tempted to take from the trust. There's a lot of factors to consider. But that said, don't let indecision, paralyze,
Well, can you have two people as a trustee?
You can.
Like, what if you say, well, I kind of know person A is, has a really kind heart, and, they're, they kind of know how I'd want to do things, especially if, helping my kids or like, you know what I mean? Just I love their personality, everything about it. And I totally trust them. They're also horrible with money and don't understand finances, but, person B maybe does. And, person B is, I trust this person, but I know it's always a calculated financial decision that they're just good. You know what I mean? Very black and white.
Right.
Can you just say, well, I just want both of those people to be trustees and they have to make a decision kind of together?
You can do that. You just have to recognize that by doing that, you're creating a committee, and every decision's
a committee.
Right. Every decision it has to be made by a committee, and you can imagine what that does.
So pros and cons.
There's pros and cons. It makes it so it's not the administration may not be as nimble, but you do get the balancing. So it's the preference of the person making the trust.
Yeah. Okay. And then maybe the last thing to cover on that is ChatGPT didn't come up with this one, but I think it's just ancillary to the conversation we just had is if you have minor children, right? Now you can designate a trustee over assets that the children are beneficiaries of, but you can't tell somebody like, well, you're the trustee, so Johnny and Susie are going to be living with you. You have to, that's a kind of a different document that you nominate somebody for guardianship. And that can be somebody different from the trustee.
Yeah. Yeah. And some people feel like that's a really good idea. And depending on the circumstances, I would agree. Sometimes it makes sense to separate out the caretaking from the purse. And I like that you used the right word there, to nominate the guardian, because in that scenario, it is going to be up to the court to appoint somebody to have that guardianship and conservatorship authority. But you can, as a parent of minor children, designate somebody as your nominee, and the court will give that a lot of weight in making that decision.
Yep. But that is an interesting aspect of estate planning. That's a spot where you cannot avoid the courts, right? And you can't say, well, I really want Preston to do it, and the court just say, okay, they're likely to if you do it properly. But they can say, well, it's really nice that was your wishes, properly executed, all this stuff. We don't like Preston,
right?
Or whatever, right? Like, and so we're, we think grandma and grandma would be a better fit, or the state thinks, whatever, for whatever circumstances, like that can be totally overridden.
Right. Yeah. It doesn't bind the court. It's just a nomination.
So,
yeah.
But super important to make, though.
Oh yeah.
If you don't, what happens if you don't? What happens if you do all the estate planning and you're like, well, obviously the trustees would just take the kids in, but no nomination has been made.
Oh,
then what?
Then the court would choose somebody.
Yeah, and the trustees could step up and say, "Well, I volunteer."
Right.
But they certainly have no obligation to do so.
Right.
And the court just goes and they pick, because in the absence of your plan, you got the state's plan. Right.
And let me say this too. The court generally wants to abide by your wishes. If you've gone to the trouble of making a nomination, the court's going to want to do that. But maybe even the bigger issue is that it lets the other people in your family know that this is the person that you chose. And by contesting that nomination, they're going against your wishes. So really, you're disincentivizing and discouraging the other extended family members from stepping in and saying, well, I feel like I should be the guardian and conservator. And that goes a long way to just avoid disputes. And that's really a major, again, a question that probably should be asked more often than it is what's the whole point of having the estate plan? And a lot of the purpose, a huge portion of the purpose of having an estate plan is to avoid family contention after the fact, when these hard decisions need to be made about who's going to make the health decisions if mom or dad's incapacitated, who's going to be, the guardian conservator of the kids, who's going to inherit what, and how are they going to inherit it.
Yep.
Answering those questions ahead of time goes a long way to preventing and discouraging family conflict when it's time for those decisions to be made and for those actions to be done.
Yeah. If you, it gets so ugly so fast. If you don't have an estate plan, quit putting your head in the sand.
Mm-hmm.
Okay. It has never helped an ostrich put their head in the sand. Right.
Yeah.
I can only imagine it's pretty standard barring very complex circumstances. You're talking about typically a commitment of 2 meetings with an attorney,
right?
Maybe an hour or so in length each.
Mm-hmm. Yeah. Right? Hour and a half each, depending on the complexity and how many questions you have. Yeah. But yeah, this is something that can be done in 2 to 3 hours.
A couple hours of time. Cost is, pretty reasonable. I'm not going to quote your costs, on here or any attorneys for that sake. But I know in Utah specifically, estate planning cost is very reasonable. Mm-hmm. I found, in my opinion.
Yeah.
So it's a relatively easy process. Some uncomfortable conversations you likely have to have with you and your spouse, but you guys can have them. Or, even if you don't have a spouse and you just have to have those own conversations with yourself, sometimes that can be tough too.
Mm-hmm.
But you can, 3 hours with an attorney, 2 to 3 hours with an attorney, hour or 2 with yourself,
mm-hmm.
pen and paper, and a minor cost, and you can get all of this stuff out of the way. So that way things can happen the way that you're hoping they happen, in a manner that you hope they happen.
Mm-hmm.
And in a cost-effective way as well.
Yeah, I think people know that they should do it. They feel like it's something that they want to do, should do. They put it off. And when they leave my office after having done it, you can tell that when I got mine done,
the weight off my shoulders was incredible.
Mm-hmm.
So I'm gonna step down off the soapbox and quit, encouraging people now if they don't if they don't want to do it. Default. Everyone's got the state's plan,
right?
And life may be over, but for everyone else, it will go on. And that being said, as we wrap up and hop off here, Preston, hey, appreciate your time. For anyone listening today, I want you guys to know none of this was legal advice in any way, including from Preston.
Right.
If you guys do want legal advice, he's licensed in Nevada, California, and Utah.
Mm-hmm.
And you can find him, Preston, at bmo.law, or on Barney McKenna Olmsted is his law firm in St. George, Utah. You guys can just Google him there and give him a call at the office. Preston not only does estate planning, but estate litigation and administration as well, which is pretty unique for estate planning attorneys. So his whole, the vast majority of his practice at this point in law is centered around estate matters.
Mm-hmm.
So appreciate your time, Preston. Anything else you want to add before we hop off?
No, just appreciate it. And this has been a blast. And yeah, thanks for having me.
Investing in real estate and securitized real estate may not be suitable for all investors and may involve special risks such as limited liquidity and demand for real property. Changes in supply and demand for real property, change in law, tenant turnover or defaults, loss of investment, competition, casualty losses, use of leverage. Real estate values may fluctuate based on economic, environmental, and other factors. There is no assurance that the investment objectives of any real estate program will be attained. Any hypothetical example contained in this document are for illustrative purposes only. They do not represent the past or future portfolio composition or performance of any specific investment and are not intended as investment advice. We suggest working with your financial professional to see which allocation opportunities may be right for you. The cost and availability of life insurance depends on factors such as age, health, and type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable.